Have you ever wondered what's really going on inside our banks, beyond the glossy annual reports and the reassuring statements from executives? Well, sometimes the most important clues are hidden in plain sight, tucked away in the most boring documents you can imagine. Routine regulatory filings. Recently, a few sharp-eyed analysts have started piecing together a story from these documents, and what they're finding is, well, it's worth talking about. These filings aren't screaming crisis. They're not front-page news. They are released on a regular schedule, using standardized language that's been around for ages. But when you look at them in context and compare them with other data, they start to paint a picture of significant strain building up within the financial system. Let's dive into what this means, why it's happening, and whether you should be concerned. To understand this, we need to look at something called unrealized losses. Imagine you buy a stock for $100. A week later, the market dips, and its price is now $80. You haven't sold it, so you haven't actually lost $20 in cash. That $20 difference is an unrealized loss. It only becomes a real or realized loss when you sell the stock for $80. Now, apply the same idea to a bank, but on a much, much larger scale. Banks hold a lot of assets, especially long-term government bonds and commercial real estate loans. In the past couple of years, interest rates have risen dramatically. This is a key point. When new bonds are issued with higher interest rates, the older bonds with lower rates that banks are holding become less valuable. No one wants to buy a 2% bond when they can get a 5% bond. So, the market value of those old bonds drops. Let's look at a real-world example, based on recent filings. One mid-sized U.S. bank recently reported its quarterly numbers. Buried in that report was a line item showing massive unrealized losses on its long-term securities. The gap between what the bank paid for these assets, their book value, and what they are worth today, their market value, was huge. In fact, it was a significant percentage of the bank's entire equity capital. Equity is the bank's safety cushion, the buffer it has to absorb losses. Now, under current accounting rules, the bank doesn't have to officially recognize these losses on its main financial statements as long as it plans to hold these bonds until they mature. This practice is designed to prevent panic and smooth out temporary market swings. After all, if the bank holds a bond for 10 years, it will get its full principal back at the end, so the day-to-day price fluctuations don't matter. In theory. But here's the catch. The theory only works if the bank doesn't need cash unexpectedly. This is where the difference between an unrealized loss on paper and a real loss of capital becomes critically important. Think of it like a game of musical chairs. As long as the music is playing and everyone has a seat, everything is fine. But what happens when the music stops? For a bank, the music stopping could be a sudden wave of depositors wanting their money back. It could be a downturn in the economy that forces them to need more cash on hand. If a bank is forced to sell those devalued bonds to raise cash, those massive unrealized losses instantly become real, tangible losses. They hit the balance sheet hard and can seriously deplete that vital capital cushion we talked about. This is exactly what we saw happen with Silicon Valley Bank last year. They had huge unrealized losses, and when depositors rushed for the exits, they had to sell their bonds at a loss, which triggered a full-blown collapse. So, the big question analysts are asking is this. Is this just an isolated issue with a few banks, or is it a systemic problem? The concerning part is that this isn't just one bank. When you scan through the filings of many different institutions, a similar pattern emerges. Many banks are sitting on these significant unrealized losses. The scale varies, of course, but the underlying issue is widespread. Let's add another layer to this, commercial real estate. This is the other major area of concern. With the rise of remote work, office buildings in many major cities are sitting half empty. This means property owners are struggling to collect rent and pay their mortgages. As a result, the value of these office buildings is dropping, and banks that lent money against these properties are now holding loans that are much riskier than they first appeared. These loans are another source of potential losses that are quietly building up on bank balance sheets. When you combine the pressure from devalued bonds with the growing risk in commercial real estate lending, you start to see why analysts are paying close attention. The system is designed to handle stress, but there's a limit. The current accounting rules, while intended to promote stability, might also be masking the true extent of the risk. They allow the problem to grow silently under the surface. It's a bit like having a slow leak in your plumbing. You might not notice it for a while, but eventually, the water damage becomes undeniable and expensive to fix. So, what does this all mean for the average person? It doesn't mean you should run to your bank and pull out all your money. In the US and many other countries, deposits are insured up to a certain amount, providing a strong safety net. However, it does mean we need to be aware of the underlying fragility. The health of the banking system affects everyone. It influences the availability of loans for homes and businesses. It impacts employment, and it underpins the entire economy. The situation we're seeing now is a slow burn issue. It's not an explosive crisis, yet. Regulators are aware of these pressures, and they have tools to manage them. For example, the Federal Reserve has a lending facility that allows banks to borrow against their bonds at their original face value, not their current, lower market value. This helps banks access cash without having to sell their assets at a loss. But this is more of a temporary fix, a painkiller, rather than a cure for the underlying problem. The real solution involves banks gradually building up their capital buffers, managing their risks more carefully, and perhaps a slow, steady recovery in asset values as the interest rate environment changes. But it's a delicate balancing act. If the economy slows down more than expected, or if another unexpected shock hits the system, these hidden strains could quickly come to the surface. This is a story about the plumbing of our financial world. It's not flashy, but it's incredibly important. The numbers in these obscure reports tell a tale of a system absorbing a lot of pressure. For now, it's holding. But the size of these unrealized losses is a clear warning sign that the margin for error has shrunk. It's a reminder that in finance, the things you don't see are often the things that matter most. So while we go about our daily lives, it's worth remembering the silent stress test that our financial institutions are undergoing every single day. The story is still unfolding, and the next chapter will depend on interest rates, the economy, and the careful decisions of both bankers and regulators. We'll be keeping a close eye on those boring regulatory filings for you. Thanks for watching. If you found this explanation helpful, please give this video a like and subscribe for more deep dives into the stories shaping our world. See you next time. Have you ever wondered what's really going on behind the headlines about the economy? It's easy to get lost in all the jargon, but today we're going to break down some of the biggest risks facing our financial system in a way that actually makes sense. We're talking about interest rates, big banks, and a ticking time bomb in the world of commercial real estate. Stick around, because understanding this could change how you see your own financial future. To really get what's happening now, we need to rewind the clock a bit, back to 2023. You might remember the news about several major banks suddenly failing. It was a scary moment, and most people assumed it was because of bad loans. But the real story was a little different and a lot more interesting. The culprit wasn't bad borrowers. It was something called interest rate risk. So, what does that even mean? Imagine this. For years, interest rates were practically zero. During that time, banks loaded up on government bonds. These are usually super safe investments, but they were paying very little interest. The banks bought trillions of dollars worth, thinking it was a secure place to park their cash. But then, the Federal Reserve started hiking interest rates aggressively to fight inflation. Suddenly, those old, low-paying bonds weren't so attractive anymore. Why would anyone want a bond paying 1% when new ones were paying 4 or 5%? As a result, the market value of the bank's bond portfolios plummeted. We're talking about losses of tens of percent in some cases. Now, as long as the banks held onto these bonds, the losses were just on paper, unrealized. The problem started when people got nervous and began pulling their deposits out. This is where the dominoes began to fall. To give depositors their money back, banks were forced to sell those bonds at a massive loss. The paper loss became a real, hard cash loss, which instantly wiped out a huge chunk of their capital, the financial cushion they need to operate safely. This chain reaction is what led to those high-profile bank failures. It was a brutal lesson in how quickly rising interest rates can destabilize even seemingly solid institutions. Even though regulators stepped in and things calmed down, the underlying problem didn't just disappear. Those unrealized losses are still sitting on bank balance sheets across the country. With interest rates staying higher for longer than anyone expected, these paper losses are stubbornly sticking around, like a ghost in the machine. It's a quiet vulnerability, a hidden risk that hasn't been resolved. And just as we were all getting used to worrying about interest rate risk, a new threat started to emerge from a completely different corner of the economy, commercial real estate, or CRE. This isn't about the house you live in. We're talking about office buildings, shopping malls, and apartment complexes. And right now, this sector is under some serious stress. Think about how much our world has changed. The rise of remote work means fewer people are going into the office every day. The boom in online shopping means fewer people are visiting physical stores. These shifts are hitting commercial properties hard. Unlike a government bond, a commercial real estate loan depends on real-world factors like rental income and occupancy rates. If tenants leave and buildings sit empty, that income dries up. Data from real estate experts shows a worrying trend. Since early 2023, the number of property owners failing to make their loan payments has been climbing steadily. Office buildings in major cities are the poster child for this problem, with vacancy rates soaring to record highs. It has become so quiet in some downtown areas that it's hard to tell what these buildings are even worth anymore because so few are being sold. This lack of transactions makes it incredibly difficult to figure out the true price of these properties. So we have these two separate problems brewing. On one hand, banks are still nursing those unrealized losses from their bond portfolios. On the other hand, the value of their commercial real estate loans is starting to look shaky. What happens when these two storms collide? This brings us to what experts are calling the maturity wall. It sounds dramatic, but it's a very real concept. Over the next couple of years, a massive wave of commercial real estate debt, we're talking hundreds of billions of dollars, is scheduled to mature. This means the loans are coming due, and property owners will need to either pay them back in full or refinance them. Now, refinancing a loan is usually no big deal, but it's a huge problem when two things happen. Property values have fallen and interest rates have skyrocketed. Imagine you took out a loan for a $10 million office building a few years ago when rates were at 3%. Today, that building might only be worth $7 million, and a new loan would come with an interest rate of 7 or 8%. Your payments would balloon, and the bank might not even be willing to lend you the full amount you need because the property's value has dropped. This is the maturity wall. It's a compressed time frame where a huge volume of these loans will be tested all at once. It doesn't automatically mean a catastrophe is coming, but it creates a period of intense pressure. Every property owner facing this wall will have to make a tough decision. Can they afford the new, higher payments? Is it even worth it to keep a property that's losing value and struggling to find tenants? For some, the answer will be no. They might choose to simply walk away and hand the keys back to the bank. This is what we call a default. And when defaults start piling up, that's when the problem shifts directly onto the bank's balance sheets. Remember those shaky CRE loans we talked about? They suddenly become realized losses. This is where it gets particularly dangerous for certain banks. While the giant, too big to fail, banks have a lot of different business lines to cushion them, many small and regional banks are heavily concentrated in commercial real estate lending. For them, CRE loans aren't just one part of their business, they are their business. These are the banks that lent money to build the local strip mall or the office park down the street. For a bank with a high concentration of these loans relative to its capital, even a small increase in defaults could be devastating. A few big commercial properties going bust could be enough to wipe out a significant portion of their capital, potentially pushing them below the minimum levels required by regulators. This could trigger a crisis of confidence, leading to deposit runs, forced asset sales, and a repeat of the exact same dynamics we saw in 2023, but this time driven by bad real estate loans instead of bonds. So you can see how these two separate issues, the old bond losses and the new real estate trouble, are connected. They both put pressure on bank capital, the very foundation of our financial system. The unrealized bond losses have already weakened that foundation, making the system more fragile. Now, the looming commercial real estate crisis threatens to deliver another powerful blow. This isn't just a problem for bankers and Wall Street traders. The health of regional banks is crucial for the entire economy. They provide the loans that small businesses use to grow and hire people. They fund community projects. If they get into trouble and have to pull back on lending, it creates a credit crunch that can slow down the entire economy and even tip us into a recession. It affects job growth, business investment, and the overall economic health of our communities. So, what are we supposed to do with this information? The point isn't to panic. The financial system has navigated tough times before. Regulators are watching the situation very closely, and banks are being stress tested to see if they can handle these potential losses. But it is a call to be aware and to be prepared. Understanding these underlying risks is the first step toward making smarter financial decisions. It helps explain why the economic news can feel so uncertain and why the Federal Reserve is being so cautious about its next moves. The story of the economy is never just one thing. It's a complex interplay of different forces. Right now, the lingering hangover from a decade of easy money is colliding with the new reality of a post-pandemic world. The events unfolding in the bond market and the commercial real estate sector are not just abstract financial news. They are critical pieces of a puzzle that will shape our economy for years to come. By understanding them, we can all be better informed about the road ahead. Thanks so much for watching. If you found this breakdown helpful, be sure to hit that like button and subscribe for more deep dives into the economic topics that matter. Let me know in the comments what you think about the risks in commercial real estate. See you in the next video. Hey everyone, welcome back to the channel. Today, we're rediving deep into a topic that affects all of us, the stability of our financial system. We've all heard about the bank runs of 2023, and it really brought home a critical point. A bank's strength is not just about the money in its vaults, it's about our confidence in it. What we saw last year was astonishing. Thanks to digital banking apps on our phones, depositors could pull out their money in seconds, faster than ever before. This showed just how quickly sentiment can turn, creating a tidal wave that even a seemingly healthy bank might struggle to survive. Now, you might be thinking, okay, but haven't banks fixed this? Well, yes and no. Since then, banks have definitely beefed up their liquidity buffers. They've stockpiled more cash and easily sellable assets to handle potential outflows, but the underlying technology, the very thing that allows us to move our money with a few taps, hasn't gone away. The structural ability for a digital bank run to happen again is still very much in place. This new reality has regulators on high alert. They're watching these dynamics like a hawk, using tools like regular reporting and intense stress tests to spot trouble before it starts. They look at metrics like loan-to-capital ratios to see if a bank is taking on too much risk in one area. And of course, we have deposit insurance, like the FDIC in the US, which acts as a crucial safety net. It's designed to prevent panic by guaranteeing your money is safe up to a certain limit. But even that has its limits. In past crises, when things got really hairy, authorities had to step in with even bigger guns. Things like emergency lending programs and sometimes extraordinary guarantees covering all deposits to stop the bleeding and restore confidence across the entire system. It was a constant balancing act between having enough protection without creating a situation where banks feel they can be reckless because they know they'll be bailed out. But the story doesn't end with banks. There's another major piece of the puzzle we need to talk about: commercial real estate. You know, the office buildings, shopping malls, and apartment complexes that shape our cities. This sector is deeply intertwined with the financial world, far beyond just the banks that lend them money. Think about who else invests in these properties: pension funds managing your retirement savings, insurance companies, and publicly traded real estate investment trusts, or REITs. They all rely on the steady income from rents and the value of these buildings. So, what happens when commercial real estate hits a rough patch, like it is now? With more people working from home and shopping online, demand for office and retail space has fallen. This pushes down property values. When that happens, it sends ripples across the entire financial ecosystem. Pension funds and insurance companies see the value of their investments shrink. This isn't just a number on a spreadsheet. It can affect their ability to pay out future claims or pensions. These are what we call mark-to-market adjustments, and they can directly impact the financial health of these major institutions, influencing broader economic conditions. So, are we headed for a crash? Is the sky falling? Not necessarily. It's more complicated than that. While the risks are real, there are also some powerful countervailing forces at play. For one, the job market has been surprisingly resilient. People are still working and spending, which helps support the economy. Also, the story isn't the same everywhere. In some regions, there's actually renewed demand for certain types of properties, like warehouses for e-commerce or modern, high-tech office spaces. And let's not forget the banks themselves. They aren't sitting idly by. They've learned lessons from the past and have been proactively increasing their loan loss reserves. This means they're setting aside more money specifically to cover potential losses from bad commercial real estate loans. So, rather than predicting a single definite outcome, what we're seeing is a landscape of possibilities. The future will be shaped by a complex interplay of factors. Where will interest rates go from here? How will the broader economy perform? What new policies will governments and central banks introduce? And critically, how will we, as consumers, investors, and business owners, behave? Our collective actions and sentiment play a huge role in all of this. And what's really happening is a massive transition. For over a decade, we lived in a world of near zero interest rates and easy money. It was a high liquidity regime where capital was cheap and flowed freely. Now, we're in a completely different environment. We've shifted to a new era characterized by higher financing costs and much more selective investment. Capital is no longer cheap, and investors are being far more cautious about where they put their money. This transition is naturally bumpy and creates uncertainty. The path forward won't be revealed all at once. We're not going to wake up one morning and have all the answers. Instead, clarity will emerge gradually, piece by piece. As more economic data comes in and as property owners with maturing loans make their refinancing decisions, we'll get a better picture of the situation. Some of the risks we're worried about today might fade away as the economy adapts. Other risks might become sharper and more defined, requiring specific action. Until then, any assessment we make has to be conditional. We have to ground our analysis in the evidence we have right now, while remaining flexible and open to revising our views as the situation evolves. It's a time for careful observation, not for panicked predictions. The financial world is navigating a significant shift, and while there are challenges, there are also signs of resilience and adaptation. The story is still being written, and we'll be here to follow it every step of the way. Thanks so much for watching. If you found this breakdown helpful, be sure to hit that like button and subscribe for more deep dives into the economic and financial trends shaping our world. Let me know your thoughts in the comments below. See you in the next video.